This is an absolute bombshell. According to Bloomberg, the U.S. Central Bank is planning the next bailout programs. This time, the bailout programs are not intended for banks, but for hedge funds. And this could be a massive, further market intervention that might happen here. The Federal Reserve is already assuming that the markets will crash, that crisis situations will occur. And that's why they're now looking at how to bail out hedge funds, assuming that in the next crisis, it is primarily the hedge funds that could lead to major problems. According to Bloomberg, the whole situation is also being compared to the 2020 corona period, suggesting that we might see a similar intervention here. And the really insidious part is that this intervention would only affect a very few hedge funds. That means it wouldn't affect the global market in any way, or a lot of small players, but it would only impact maybe 5 to 10 large hedge funds. But that also means we would see a massive redistribution. This means profits are privatized and losses are socialized, because that's exactly what always happens with bailout programs, where banks or hedge funds skim off the profits and then simply pass the losses onto the citizens in the form of redistribution packages, money packages, and so on. That's precisely the reason why Bitcoin exists. Satoshi Nakamoto wrote in the Genesis block back then, "Hey, the chancellor is on the brink of a bailout program, and Bitcoin is the counter-design where there are no bailouts. We don't want bailouts, we don't want banks, and so on." And now there are no more banks here, but in the future, it's the hedge funds that are supposed to be saved. And the really insidious thing is that these hedge funds can take massive risks because they know very well that they will be bailed out here. If anything goes wrong, these hedge funds will be bailed out here. But now we're taking a close look at what you need to know about this, why it's also relevant for Bitcoin, what the Federal Reserve has to do with it, why they're somehow panicking and want to bail out the hedge funds. There's this article on Bloomberg, and it's based on a paper that was published here. It says here, fetch herd to explore hedge fund bailout tool for basis trade. So, to better represent the basis trade, somehow, the Fed is now working meticulously to create a bailout tool because they are panicking that the hedge funds could crash. And what is stated in this article is really highly explosive. It states here that, according to a group of experts, the U.S. Federal Reserve should consider an emergency program to dissolve highly leveraged hedge funds in case of a crisis in the $29 trillion U.S. Treasury market. Because the problem is, if there is a crash in the Treasury market or something like that, then the banks could also find themselves in trouble again. Banks can find themselves in a tight spot. We've seen this happen often. For example, when interest rates have risen too high, bond values have fallen. What do the banks have in their portfolios? They all have bonds, so all the banks are underwater. Now the banks have a big problem, because essentially their assets are worth nothing. Now they have to potentially resolve margin calls, because they might have to sell some assets, because they are leveraged again, meaning they use bonds to create new money, or to do other things with it. This means they would now tend to sell assets, sell bonds, but they are worth nothing anymore. Or on the other hand, there's the problem that as so many people want to withdraw their money now, they would have to sell the bonds. But if they sell the bonds are worth nothing. They get less for them than what they paid when they bought the bonds. That's the next problem. This means everything is interconnected here. This means if the hedge funds fall, then the banks have a problem. If the banks have a problem, then the hedge funds also have a problem. If the hedge funds have a problem, then the small investors have a problem, and so on. And if the hedge funds fall, then the stock markets could potentially go down with them. If the banks fall, the stock markets can go down with them. This means it's now such a complex system that sometimes you don't even know where to make adjustments, because if a cog gets out of sync, it can really have devastating ripple effects on the entire financial market. As Bloomberg continues to report, this is about the bond trader. An abrupt and massive withdrawal from these estimated $1 million arbitrage deals by hedge funds, known as the basis trade. This could destabilize not only the bond trader, but also other markets. This is what I just explained, and it could necessitate intervention by the Fed to ensure financial stability. Already in March 2020, at the beginning of the COVID crisis, the Fed intervened by purchasing government bonds worth around $1.6 trillion in a few weeks. So, a comparison is now being made with the corona phase, and something similar could happen here with the hedge funds, where bailout packages or something like that could be put together in a relatively short time. I mean, this is what's relevant here for Bitcoin. For Bitcoin, all of this is good. Bailouts are good for Bitcoin. If somehow the market collapses, it's good for Bitcoin. In the short term, it's always bad at first because Bitcoin gets pulled down by the downward momentum. But in the long term, a collapsing monetary system is here. Always positive for Bitcoin, because Bitcoin is an alternative here without bailouts, without central banks, without government interventions. It is said here in a quote from the people who want to generate the bailout program that if a worst-case scenario should occur, and the Fed has to intervene, it should do so in a secured manner. So, having a plan B or something like that up your sleeve, and then it basically talks about the risks. So what is the risk here? First, you need to understand a few things. The focus here is on the so-called basis trade or the basis business. Hedge funds exploit minimal price differences between government bonds and their derivative futures to make profits. So, they are doing an arbitrage business here. That's what many large financial institutions and so on do. They earn simply by having such a mega volume. And in each trade, they make very small, minimal profits. But because the volume is so high, they earn from the arbitrage business. And then it is said here loudly. Kashipa, who is someone involved here, says this business is very concentrated. Presumably, fewer than 10 hedge funds are operating it. And that's exactly it. That's why I said earlier, this will only affect 5 or 10 or so hedge funds or something like that. I saw another video about it by George Gammon, who covered exactly the same topic on his English channel. And it was mentioned that Larry Fink also has a son named Enzo here. And in any case, he would also be a hedge fund maker here. And, for example, such a hedge fund would be affected here. That means Larry Fink's son would then be bailed out here if the fund here should happen to gamble it away. And now the problem is described here that if the funds here, meaning the hedge funds, have to quickly liquidate their positions, for example, if there are margin calls or whatever, I don't know what could cause the position to be liquidated here. Or if one simply wants to sell or too many people want to sell at the same time, the volume could become too large for the bond traders. And in 2020, the basis trade business here was at a volume of around about $500 billion. Today, it's now twice as large. And this is the big danger that the Federal Reserve sees here. And then they want to relieve the pressure on the traders. And in the worst case, if, for example, too many people here would sell and simply here, too many positions are liquidated at the same time, then the Federal Reserve could step in as a buyer. That means, similar to QE, if, for example, there are no more buyers for U.S. Treasury bonds on the open market, then the Federal Reserve steps in and injects liquidity into the market. And it could be the same now with hedge funds. If too many trades are liquidated too quickly here, if too many positions are dissolved at once, then it might be that the market makers or those who handle all of this can't keep up. But in any case, the bond traders, I think we have to say, can't keep up anymore, that they might not be able to sell the bonds to anyone. And then it could lead to a collapse here if the Federal Reserve doesn't step in. And if the Federal Reserve can then buy these bonds directly, liquidity will be pumped into the market, and the system can be bailed out again. Yeah, that's just it. The question is that good or not? I mean, from the Fed's perspective, or from the perspective of hedge funds, or maybe it's good from their perspective, but perhaps not so good from the perspective of many other people. In the short term, you might be able to avoid greater pain initially, but in the long term, it leads to more liquidity entering the market, just like with QE. It's not called QE now, it's called something else, but similarly, government bonds are being purchased here as well. And whenever the Federal Reserve buys government bonds, whether it's called QE or something else, the money supply will increase in the long term because eventually, this money will flow back into the real economy, and then inflation goes up, which also pumps Bitcoin and other risk assets back up. That's why this is potentially not something bad for Bitcoin here, because the thing is, normally, when such problems arise, for example, you resort to the repo market, or other secondary markets, and so on. And it also says in the article here, they want to prevent it from spilling over into the repo market, and so on. That means, before you would somehow pull money out of the repo market or something, you just bring in the central bank right away and buy up the bonds directly. We have the exact same problem with banks, that there is always this moral hazard. That means there is moral hazard with politicians, with banks, with hedge funds, with large investment houses, and so on. These people know exactly, hey, if I make a mistake, it doesn't matter at all, because I don't have to be liable for it. And there is always a bailout package. If necessary, the central bank steps in. If necessary, we invent some tricks again, and so on. And that just creates very, very poor market incentives. Because now, as a hedge fund, you don't have the incentive to be efficient and effective, but you have the incentive to take maximum risk. You really go to the limit. Take on a risk that no normal person would take, because you know very well, in the worst case, the central bank will step in. And the same applies to banks. You know, hey, I can take a very, very high risk if I'm JP Morgan. If I'm a too big to fail bank, I can take on a very, very high risk. This doesn't mean that it necessarily leads to just letting things crash, because you also want to extract as much as possible here, and so on. That means you're always on the threshold between, okay, too much risk, and it's just barely manageable, but generally always a bit too much risk, because if something were to happen, then there's the Federal Reserve to catch it all, and that's just unfair, because an ordinary person can't take on such high risks, because they know very well, okay, if I gamble wrong with my business, if I'm too leveraged, and so on, if I get margin calls, then I have to meet these margin calls, and then I'm just bankrupt. And then, in theory, my personal assets might still have to be liable for it. Then my house has to be sold. Then my motorcycle has to be sold. My TV has to be sold. And this risk just doesn't exist for the big players, because they know, okay, they can take on very, very high risks. They can take on very, very much leverage. And if the margin calls come and you can't meet the margin calls, then Jeroen Paul comes and says, hey, whatever it takes, we're bailing out the whole place here. And then we have the big mess again, where the citizens have to pay for it. But on the other hand, the winner, the laughing winner, is always Bitcoin. We also saw it during the Corona period back then. When did Bitcoin massively go up? It was when the QE programs were started by the central bank. That means everything happening here is very, very critical to observe, but ultimately tends to be very, very positive for Bitcoin. I know this was a bit of a complex topic today. It's not so easy to check through. I hope I explained it somewhat clearly, or if I got anything wrong. If I presented it incorrectly, explained it wrong, or if you have corrections, feel free to write them in the comments. This is really a bit of a tricky story here with all the hedge funds. I mean, it's very difficult to see through. I have the feeling that even the hedge funds themselves don't fully understand exactly what's going on here. I'm going to add a link below on how you can get censorship-free money. With the code BitcoinHotel, you can get up to 20% off the fees. Super easy, super simple, definitely easier than somehow burning money with hedge funds. Check it out if you want to buy Bitcoin. Absolute recommendation, 21 Bitcoin. And if you're looking for an optimal hardware wallet, I'll also include a link to a TREZOR hardware wallet. Here, you can also get a discount with the code. Here you can easily and simply store your Bitcoin in the best and safest way on the Bitcoin network by using a hardware wallet. That means definitely check out TREZOR if you still need a hardware wallet. I always recommend it, absolutely. Guys, see you, peace out.